Assalamu alaikum and welcome to the Oasis Focus on Finance show. Today we discuss two special emotions when it comes to investment and savings, fear and greed, and the impact of these two emotions upon our investment and savings. Too often a person, for example, gets overcome by greed, so it's a get-rich-quick scheme which often results in a disaster. Or alternatively, through fear, a person may cash in their investments and again also lose money. It seems as if the answer to all of this is a balance. And to help us through this are Fahad, Shaikh and Ebrahim Rawoot. Gentlemen, assalamu alaikum. Welcome to the show.
Walaikum salam, Shaikh.
Fahad, let's have a look. What is the actual impact of fear and greed on savings and investment?
Shafiq, I think understanding cycles of greed and fear is very core to understanding economic cycles. So if you look at the global economy, it goes through booms and busts. The booms are usually driven by accumulation of excess credit, which leads to abnormal growth. And then as soon as that credit is shaken out of the system, it leads to recession. And I think something very recent or a good case study to think about would be the global financial crisis in the US, which started in the US. So we saw that during the 2000s, US households, indebted themselves to extreme levels. In some cases, some of the individuals had 2 or 3 mortgages, which they were using to finance consumption or, buying houses that they couldn't afford. And it wasn't just greed on the people who were taking that debt. It was also the banks who was providing that unsustainable level of funding, trying to achieve short-term profits. And we eventually know how that ended up. As soon as that music stopped, as soon as people realized that lending was unsustainable, we saw lending stop off immediately. That led to a contraction in what consumers were able to consume. There were a lot of bad debts, and we saw a lot of banking failures come through at that time. So that's a very clear example of how greed leads to very strong economic growth, to some extent unsustainable. And then, as that thing unwinds, it leads to an economic recession. And if you go back in history, you'll see the East Asian financial crisis, you saw the Greek crisis, we've spoken about that previously, and all of them are pretty much culmination, of pretty much greed leading to unsustainable levels of growth. Then another angle which we can think about, or another manifestation of greed, is in the public sector. There's corruption, for example. We've often heard about tenderpreneurs, for example. So that kind of greed also has permanent impact on economic growth structurally. And so I think it's both the private and the public sector. Secondly, lastly, if you talk about fear, for example, often we see there's inaction by government. Often government officials might not want to take decisions which upset certain factions of the economy or for certain factions of the country. And often that is that inaction or the fear of taking action, that impacts economic growth, leads to higher unemployment, leads to, structurally lower growth. So what we have seen historically, that it's across countries, it's both the private and the public sector where the fear and greed actually coincides with economic cycles of boom and bust.
Okay, now you've spoken about it in the collective issue. What about the individual one? What about the behavior of the investor?
I think one of the very common things that we see in terms of greed and fear when it comes to investing is if you think about momentum investing versus value investing. So what we often see is that when markets have had a very strong run, markets or individual stocks have had a very strong run, valuations are very expensive, and that's when people are feeling the most confident and willing to commit the most amount of money into the market or into stocks, for example, rather than being cautious. And again, their thinking is driven by the fact that, in terms of making short-term gains rather than looking at their long-term saving objectives. Similarly, on the flip side, when markets are extremely low, or when markets have come off and you're getting assets which are worth 100, you're getting it for 50. That's where, people are afraid of committing, or this fear of committing new money to investments. And what you'll often see is when markets are coming down, people are scared they're actually taking their money out of the market rather than, at that time they should be investing into the market. So I think, when people try and time these things and not look through the cycle, look at the long-term saving investment needs, is where it might impact your long-term saving objectives. Similarly, what we often see a lot of people do when it comes to financial markets is try to time. So they're trying to make short-term gains by getting in, getting out of the market. And often we see that it's unlikely that someone's able to do that sustainably. So, obviously that also detracts from your long-term saving objectives. And lastly, it's short-term gains where greed really comes in. So often we see people get, there are advertisements out there, and I think Ebrahim will speak about it later, but advertisements regarding investments which offer 25, 30, 40% returns over the very short term. And eventually what we find is that they turn out to be the Ponzi schemes, pyramid schemes, or some sort of unsustainable, highly risky sort of investments. And people end up losing their investments over that. So I think there's a lot of areas with both greed and fear impact investment behavior. But I think it's our job. I think it's our job to make sure that we look at things through the cycle, only invest when things are undervalued, and deliver on our objective of long-term wealth creation while taking much lower risk.
Shafiq, maybe just to add on to what Fahad mentioned, is so important. There's that old saying, don't try and time the market, rather spend time in the market, and that's so critical. And then that other comment about the herd mentality. What did that person do? So let me follow what that person did. But the timing between the two is so different that the one that comes second in line actually remains second because he never catches up with the person that actually started this whole initiative. So yeah, it's very important what he's mentioning, and I think we need to be more cognizant of what is really out there in order to be able to generate sustainable returns.
Yeah, Ebrahim, tell us more about this timing of the market, particularly how it would relate to investor returns.
The real bottom line is, there needs to be this distinction between long-term investing and short-term trading. And normally with short-term trading, you generally don't make money. Why? Because you're either buying or selling in a couple of days' time, in a couple of weeks' time, or sometimes you don't even hold it for a day, and then you continue to buy and sell. Now, really, people that are in it for the long run, but they're doing this continuous trading, generally don't make money. Why? Because of this exorbitant cost. They call it transactional cost. There's switching costs. There's brokerage fees. There's a lot of costs that people are incurring, and we fail to realize how this negatively impacts your investment. Now, take example, if you bought a share or a stock today, or let's say at the beginning of the year for 100 Rand, that 100 Rand at the end of the year is now 120 Rand. So what if you realize is a 20 Rand gain on the share of your purchase. But now if you continue to do this trading, whether you're buying and selling the same stock, let's assume you buy and sell 20 times in the year at a cost of 50 cents. That's going to be 10 Rand, that's going to impact your return. Now what is happening is, initially, if you had held that stock for 1 year, you would have made a 20 Rand return. But because of this exorbitant cost in between, your real return is now only 10 Rand. Now take a long-term effect into account. We have this saying compounding, the return on return over a period in time. So that 20 Rand over a 1 year, 3 year, 5 year period would have substantially resulted in a huge amount of value, as opposed to that trader that went and bought and sold in between the weeks, in between the years, and is actually devalued his end result at the end of the day.
Ebrahim, we also get something called risk and reward. How does this factor into investors' decisions and the eventual outcome?
I think, it's two very important concepts. And, if you use a coin, a coin has two sides. There's the heads and there's the tails. So generally when we as investors we look at the return, and we say, and we actually place a very high emphasis on the return. I'm happy to get a return no matter what the risk I'm taking. But that risk is the second part of the coin. Are we comfortable taking a huge amount of risk in order to generate a huge amount of return? Or are we saying, what, I actually want to take the least amount of risk and get the best possible return? And I think, that's really what we should be encouraging investors to look at. Fahad mentioned it, there's a lot of schemes out there, and we'll go through it in detail. But there's a lot of schemes out there, huge returns. But we fail to realize what is the risk we're taking in order to have generated or received that potential return. So you have certain, investment language that we use, and there's this concept called price volatility. What is the difference between the price that I buy and the price that I sell? And if it's an extreme difference between the two, generally there's a certain amount of risk. Now, if you take, for example, your risk versus return scenario. So traditionally, many financial professionals, they use this price volatility concept, or the rate at which, the the price fluctuates up or down. Now, if you take a feel for what the risk is and you take a feel for what the return is, you can establish what the risk ultimately is going to be. And this is your traditional Sharpe ratio, which we see continuously in financial magazines, and it's being used by asset managers. A second measure, is if you also look at the downside volatility. And this is to say, as an asset manager, how am I being protected against these little shocks that's coming through the market? Am I getting a heart attack at the end of the day, or am I able to sustain that type of shock? And in both cases, the higher the ratio, the better the performance is going to be. So essentially what you want to be looking for, is a consistently higher ratio to your peer group in order to ensure I am giving you the best possible return at the least amount of risk. And that way, you're in a very comfortable, protected environment. Yes, there's going to be market movements, but we're able to sustain it.
Ebrahim, let's have a look at something called the Ponzi scheme, which it plays upon our weaknesses, doesn't it? Our willingness to try and get rich quick. It plays on our fears, greed, everything. Tell us about a Ponzi scheme.
Well, Shafiq, there's been so many out there in the past, and we need to learn from the stories of the past in order not to be able to repeat the same type of mistakes. And with all these schemes, whether it was pyramid schemes, Ponzi schemes, they all attracted wonderful results. But the question was just how true were these results at the end of the day?
And some victims too.
Certainly, and you feel sorry for these victims because some of them have been misleaded, some of them have been misguided, and then some of them just fell into that trap of greed, and they went with the flow. But Shafiq, really, that good old adage that if it's too good to be true, then really we need to be questioning it. So what is a Ponzi scheme? It's really just a shell game, and that shell game is there to ensure that money from new investors is being used to pay the old investors. Now what happens? Eventually your new investor starts becoming fewer, there's less of them around, and the less you have of the new investors, the less money you have to pay the old investors. And eventually this whole shell just falls apart. Now, how do you really spot a Ponzi scheme? Well, there's a couple of ways of doing it. First of all, look out for the abnormally high returns. And then also look out for something that is, where the returns are very consistent. Fahad mentioned markets go up, markets go down. So naturally your investment should be going up or down. So don't tell me, after 10, 20 years, your investment is still the same. Something is not right in that type of scheme. And then secondly, you have these companies that make these impossible sayings, double back your money in 6 months or 3 months, or, even a 20% return in 1 month. All these type of things should be triggering some sort of thing in your brain to say, is this really legitimate or is it not legitimate? And then, they have these barriers to exit where I cannot get my money out over a certain period in time. Now, you spoke about Ponzi schemes. Then we have this, the other type of scheme, which was called pyramid schemes. And there were so many of them around, and so many of them lost out money at the end of the day. And what does a pyramid scheme really do? It's there to try and promise members that you're going to get money, but you need to bring new people on board. So really all you're doing is it's the ability to bring new investors into the equation, and you start rewarding yourself. And eventually, you start seeing this pyramid being built. But really what happens? A pyramid offers no value, or probably very little value at the end of the day. And you're recruiting your new members. And all of a sudden what happens is, the pyramid starts falling wayside because, there's no new recruiting into the equation. Now, how do you go and identify, a pyramid scheme? Well, we need to be careful here because with a pyramid scheme, it's becoming more difficult to really separate it from, the multi-level type of marketing. People have become smart. They've started using proper brochures, proper advertising, and you think, hey, this is a legitimate exercise. But, potentials for pyramid schemes are, the emphasis is more on recruiting new members as opposed to products. Secondly, the business startup cost is very, very high. And then lastly, the company is not going to buy unsold inventory. So, it becomes a bit of an issue at the end of the day. So really what we need to do is, we need to identify all these type of signals to say, are these legitimate regulated products, or are these schemes that is not going to be sustainable over the long term?
So Ebrahim, how as savers and investors do we protect ourselves against these cycles of fear and greed?
I think, really the main critical point is we need to educate ourselves. There's a lot of information on the internet, in the newspapers. There are financial management companies that speaking to you about these warning points. And I think we need to educate ourselves. We need to say, there's no such thing as getting rich quick. It is a sustainable process we need to follow, and that sustainable process is going to give you the ability to generate returns in a more regulated environment. Then we also need to start identifying and understanding the differences between Ponzi schemes, pyramid schemes, and what we would refer to as your traditional investments. These are good investments. But then with traditional investments, we need to say, well, what is the difference between high-risk investments and what is the difference between low-risk investments? And you speak to your financial advisor, he will do a needs analysis on you to say, does this product suit you as an individual? And if it does suit you, we do a recommendation process. Then you also need to understand whether your asset manager is engaging in these complex activities, complex share trading, opaque investments. And if it's unclear, you need to stay away from it. So there's educating yourself. Then I think the second best way to look at it is also to say, are you as an individual comfortable with what you're actually doing? Is your asset manager going to look in your best interest? And if it's going to look in your best interest, again, this becomes a product that is for you, so you start ticking it in the right box. And then I think thirdly, which is also very important, is the track record of your asset manager or your investment manager. Don't look at an asset manager that's only been around for the last couple of days. He's doing huge promises to you, and you don't have anything to fall back on. So, a track record of 5 years or 10 years gives you a bit of comfort that, this asset manager has been through different cycles, whether it's the boom or the bear phases, and he's been able to sustain himself. And by doing this, we're able to, I think, really limit the influence of these fraudsters and scammers around. And, these are individuals that we should, not entertain, we should not engage with him, because ultimately you're going to be, the person that's going to lose out at the end of the day.
Right. Now Fahad, Ebrahim has spoken about the regulatory environment. What sort of regulatory environment does Oasis work within?
Shafiq, across all our product lines, we basically adhere to the highest regulatory principles, highest regulatory authorities. So if you look at the Oasis Crescent Management Company, that obtained its unit trust management license from the South African Financial Services Board as far back as December 1999, and we continue to and that entity continues to be regulated by the FSB. If you look at the Oasis Crescent Retirement Solutions, that received a pension fund administration license also from the South African Financial Services Board. And I can go on across the different products and across the different products that we offer. But that's on the external side. Then even internally, we have a very strict, almost an ethos in terms of compliance, in terms of making sure that we're operating with the highest level of compliance, diligence, and to make sure that we're delivering on the promise that we do make to our clients. And if you look at our own, from an investment perspective, we adhere to the CFA Code of Conduct. We're signatories to the Principles for Responsible Investing. And I think it's because all these things were built into our investment philosophy, into our processes from inception. We've seen the benefit of that come through in terms of our investment performance over a number of years. And I think, as Ebrahim mentioned, it's that relationship that and the trust that we've built with our clients over so many years, that really benefits the business, and that makes sure that we continue to deliver on our promise.
How, as an institution, does Oasis ensure that it doesn't get caught up in these cycles of fear and greed when you're managing a lot of clients' money?
Since inception, we've been very consistent in terms of our investment philosophy, in terms of our investment objective. If you look at our investment objective, it's always been real wealth creation for our clients, while making sure, like Ebrahim spoke a lot about risk and return, while making sure we're taking a lot lower risk than the market. At the same time, when it comes to investing in whatever companies that we are investing in, we have a strict share selection criteria in terms of it needs to be a market-leading company with a strong competitive advantage and the ability to deliver cash flows through the economic cycle. So we've spoken about booms, we've spoken about busts. You don't want to be invested in the company which does really well when things are going well, but as soon as the tide goes out, your company is either bankrupt or doesn't have a competitive advantage to consistently generate the cash flows. So I think that's where the investment team really comes in to making sure we identify those opportunities. And Shafiq, that's on the quality side of companies. And the most important thing that we look at is that you need to be buying companies significantly below what their fair or intrinsic values are. And the key really is that you don't get caught up in the momentum. So if something's doing well and everyone's running after that, but if we believe that certain asset is overvalued, as part of a philosophy, we won't chase that. We won't expose our clients' money to that, because there's obviously significant risk of capital loss if you're investing in something that's overvalued. And on the flip side, when people are scared, when the markets are coming off, that's when we really get excited. That's when we sharpen our pencils. And that's, when things get really exciting from an investment team perspective. So at the end of the day, markets will go up, markets will go down. We just need to remain consistent in our investment philosophy, focus on quality, focus on valuations, making sure that when markets come down, our funds don't come down by the same amount. Ebrahim spoke about the Sharpe ratio, downside protection. So making sure we continue to deliver on that. And at the end of the day, make sure that our clients' money is well looked after.
I think maybe just to add to what Fahad has mentioned, and I think it's so critical, as investors, we tend to let emotion get the better of us, and we should really not be doing that. There's a huge amount of opportunity, in these bear phases when asset managers and investment managers are finding massive opportunities, and those are opportunities that you identify today in order to be able to reward or reap the rewards over the long term. So yes, as individuals, we should not be following the herd mentality. We should not be making investment decisions based on hearsay and thearsay. And really, we should be doing it based on detailed research, fundamental sense, and ensuring that we operate in this highly perfect regulated environment. If we can adopt that, I think we're very much on the right track, Shafiq, and really start taking this greed and fear concept out of the equation and start living by the concepts of regulated environments, with trustworthy asset managers, with good long track records, and that is what we need to be looking for.
Ebrahim, Rawoot, Fahad, Shaikh, thanks for talking to us about the impact of fear and greed on savings and investments. Gentlemen, thank you.
Thank you, Shafiq.
And that concludes today's show, our third in the special Ramadan series. A special thanks to our guests, Fahad, Shaikh and Ebrahim Rawoot, who spoke to us about the impact of fear and greed on investment and savings. Should you wish to watch this or any of our other shows, you can log into the Oasis Crescent YouTube channel. If you would like to contact Oasis, call 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm Shafiq Morton. Assalamu alaikum wa rahmatullah.